30 trillion in national debt. Today's video, I want to get into the breakdown of the national debt and what countries are holding what. It's very interesting, in my opinion, on where this is all going. Let's get into it. Before we get into who is holding all this 30 trillion in debt, I want to give my opinion on this issue. The Fed has officially turned the corner to being fully MMT based, in my opinion. So by the time the Fed pushes the funds rate towards 3%, there's a very good chance our economy, will be ready to enter the next recession. Don't panic. But at which point the Fed will immediately slash the funds rate back to, let's say, 0.25% and restart QE. The government will step in with more rent and mortgage forbearance, and the craziness will start all over again. Raising rates, ladies and gentlemen, is the easy part. That's the first step. So unwinding all the MBS and enough treasuries to get the Fed's balance sheet down to a reasonable level, let's say 3 or 4 trillion, is the hard part. And I don't foresee the Fed successfully maneuvering a soft landing with regards to its balance sheets. They just don't have a good track record, folks. There's just too much money right now to be absorbed by the system when, we're running, and I've talked about this, we're running 1 to 1.5 trillion annual deficits for the foreseeable future. The brakes aren't being put on, and I see it continuing. The problem, though, is that most, if not all, other assets value is directly impacted by the Fed's interest rate manipulation. And downward, for the last at least 25 years. And here's why. Some reasons why. Number one, essentially all professional investors and institutional investors are going to, at a minimum, weigh the value of an asset, right, investment against its projected future income stream, discounted to the present by an interest rate. So I've talked about this. This is, the famous discounted cash flow formula, the DCF. And, and a lot of it, professional investors are going to use the DCF to more than weigh the values. They will expend a ton of analytical energy doing highly detailed DCF analysis for, explicit validation purposes. So the problem, every DCF validation by mathematical definition is profoundly impacted by the interest rate used. So the lower interest rate, by definition, spike asset validations because future asset income streams are less heavily discounted to present. So, the bean counters are going to be counted. So, and guess what the Fed has been doing the last 20 years with interest rates? Printing money, messing with it, printing money. So this is precisely why almost every asset class is overvalued, because the Fed has artificially manipulated interest rates downward. So the problem, all these asset classes value have become more and more anchored, correlated to nothing other than these artificially low interest rates, as opposed to their own interest, internal pro cons, financially. It's just based on the interest rate. So as asset values become less and less responsive to their own internal financial prospects and more responsive only to the manipulated interest rates, these assets become more and more vulnerable, volatile to changes in the GBT interest rate manipulation policies. So, and the Fed is no God emperor with access to infinite free lunches. Ultimately, its interest rate manipulation via money printing is constrained by other macroeconomic factors, like turning its fiat into toilet paper. I mean, so when the Fed is compelled to let interest rates freely float upwards, asset values collapse. So that's the concern I have. Yes, the dollar is the reserve currency right now, and the powers to be would love to go digital to control more of the money. That's an issue as well, digital currency. So we talk about the national debt, spiking U.S. national debt hits a ridiculous 30 trillion. Check out this 30 trillion chart. Trillions disappearing so fast, they're hard to even see. And now the TGA is spiking again, the incredible spiking U.S. gross national debt, hit the big one, 30 trillion. Look at debt breakdown by holding company. Look at the debt breakdown by holding company. Nice. That gives you a perspective. So that's the amount the government owes and has issued in Treasury securities that are outstanding as of January 31st. So since March 2020, the U.S. gross national debt has spiked by a monstrous 27%, or by 6.5 trillion. Over the past 12 months, during the strongest economic growth since 1984, the national debt has spiked by 2.2 trillion. See the difference? So who the hell is buying and holding all these Treasury securities? It's an interesting question. The question is particularly hot because these are very unattractive instruments. Yields are still well below 1% for most short-term Treasury bills, and even the 10-year Treasury maturity yield only around roughly 2%, while CPI inflation has blasted off and hit roughly 7.5%. It's not stopping, creating the worst punishment yields ever. So to top it off, the most reckless Fed ever is still repressing interest rates, and still, though, at a much slower pace, printing money. The whole thing is a tragic clown show, ladies and gentlemen, and yet every single one of the Treasury securities was bought and is held by some entity. Who are they? Who the hell are they? This is my, question, and I think it's an important question for these iffy times right now. So foreign creditors of the U.S. government, foreign holders of treasuries right now stands at 7.74 trillion, a record up by 790 billion. That's plus 11% since March 2020, and up to 9.5% year over year, according to the Treasury Department's International Capital TIC data. So about 4.1 trillion of it is held by foreign central banks and government entities. The rest, is by foreign institutional investors, corporate entities, banks, and individuals. So, their foreign holdings have increased more slowly than the incredibly spiking U.S. gross national debt over the years, and in December accounted for roughly 26.1% of the debt, down from 34%, a range that's from 2012 through 2015. So if you look at the dollar amount holdings, take a look at this. Look at the dollar amount holdings, total foreign holdings as 1% of the total U.S. debt, and that's the red line on the right scale. So China's got roughly about 1.07 trillion. The second largest foreign creditor of the U.S. has cut its holdings since March 2020 by a small 16 billion. Japan's coming in at roughly 1.2 $1.30 trillion at the end of December. The largest foreign creditor of the U.S. has increased its holdings since March 2020 by $31 billion. Incredible. So given this incredibly spike in U.S. gross national debt and the relatively stable holdings over the years of Japan and China, their importance as creditors to the U.S. has been declining for years. And in December, Japan's share dropped to 4.4%. You see that as the purple line, and China's share, if you look at China, the red, dropped to 3.6%. So they're not the ones that are bailing out the U.S. government. You know, other big foreign holders don't measure up to the task. You know, not so ironically, most of the 10 biggest foreign holders after Japan and China are tax havens and financial centers. Some of them small countries that cater to U.S. corporations, of course, that, you know, want offshore mailbox entities where some of their treasury holdings are registered offshore. So the moving on, the UK's London laundromat, roughly $647 billion, about 2.2% of the total U.S. debt outstanding, and growing up rapidly, up 47% from a year ago. The number 3 foreign holder of U.S. Treasury securities is concentrated on London's financial center, lovingly called London Laundromat, holds $647 billion. So that's interesting. The ultimate holders of these treasuries registered at accounts in the London Laundromat could be anything from Russian oligarchs to U.S. corporations. Just roll the dice. Who's in that mix? So check this out. The top 10 foreign holders behind Japan, number 1, and China. So, you know, coming in at number 1, the UK London Financial Center, as I said, $647 billion. That's plus 47%. Ireland, number 2, at $334 billion. Luxembourg, that's a haven, $323 billion. They're plus 12%. Switzerland, number 4, $288 billion. Belgium, coming in at $272 billion. That's plus 7%. Ooh, the Cayman Islands. Got about $262 billion sitting in the Cayman Islands. That's plus 17%. Taiwan, $251 billion. They're plus 7%. Brazil, $244 billion. Hong Kong, $226 billion. And coming in at number 10, France, $224 billion, plus 101%. So big trade deficits don't mean those countries have to hold a lot of treasury securities. For, you know, Mexico and Germany, the 2 countries outside China and Japan with which the U.S. has had gigantic trade deficits for years, hold only $83 billion and $46 billion respectively in treasury securities. So domestic creditors of the U.S. government, the U.S. government internal holdings, roughly $6.47 trillion. That's a record. It's up to $327 billion. That's plus 5.3% year over year, and up by $461 billion. That's plus 7.7% from March 2020. That's according to the Treasury Department data. Absolutely incredible. So the U.S. government pension funds for military personnel and federal civilian employees, the U.S. Social Security Trust Fund, and other federal government funds invest their massive balances exclusively in, guess what, in treasury securities. So this debt held internally is often and ridiculously described as debt that the government owes itself. So, but that's ridiculous. It's owed to current and future beneficiaries of those funds. Even this increase couldn't keep up with the incredibly spike in U.S. national debt, and the share of the U.S. Treasuries held by these funds at roughly 21.9% remain near the multi-decade low of prior quarter, and we're down from a share of 45% in 2008. So it just keeps going and going. It's incredible when you break this down where all this debt is, and you know the good old FR moving on to the Federal Reserve, 5.65 trillion at the end of December, up by nearly 1 trillion. That's plus 20% year over year, and up by a gargantuan 2.31 trillion. That's plus 69% from March 2020. So the result of the most reckless money printing binge ever, in my opinion, and from what the experts are saying. So the Fed's holdings of Treasury securities reached a record 19.1% of the incredible spike in U.S. national debt in Q3 alone, and held at the record in Q4. So the Federal Reserve, unlimited money printing. So moving on to U.S. banks, 1.66 trillion according to the Federal Reserve Board of Governors data on the bank balance sheets. That was up by 450 billion. That's plus 37% year over year, and about 690 billion. That's plus 71% from March 2020. So as banks loaded up with cash are moving on to Treasury securities, they now hold incredibly amount of Treasury securities. So they're amping up. Other U.S. institutional and individual investors are roughly 8.09 trillion, down by 522 billion. That's minus 6.1% year over year, but up a whopping 1.68 trillion. That's plus 26% from March 2020. So during the pandemic, these include bond, mutual funds, and money market funds, U.S. pension funds, individual investors, U.S. insurance companies, state and local governments, and other U.S. entities. So the sharp volatility of these holdings indicate that some groups dumped treasuries in March 2020. That's interesting. And then when the Fed made clear that it's going hog wild, which they did during the pandemic, they jumped back into the Treasury market and bought everything in sight. Their holdings hit a peak in Q1 2021. Since then, they backed off a little bit, and after the debt ceiling, charade that happens every now and then was resolved, the government began borrowing again on a large scale, and the proceeds from these debt sales went into the TGA to await getting spent, and the TGA has now spiked again to 742 billion as of January 31st. So these are enormous amounts of money that are getting borrowed and thrown around here in a matter of days, ladies and gentlemen, in a matter of days. It's interesting how you see where the money's broken down. Everyone used to say China, in my opinion, was the largest creditor. But when you talk about China, Japan, and then you look at the top 10 below that, it's interesting and how this money's funneled based on market manipulation. And when things change, with example, the pandemic, and how money is shifted around, and then it's thrown out of treasuries and back into treasuries. So I think it's really interesting. It's a major problem. It's one big Ponzi scheme right now. Dollar's a reserve currency. We control the cards there. There's an interesting book on that I read, how that works. If countries would threaten to go off the dollar, I'm not worried about that in the short term. But this spending is out of control. It's just not going to be sustainable. And the generations after me will be paying for this a long time. But something's got to change. 30 trillion. How quickly are we going to get to 40? Have a great week. Take care.